trade the SPY out of sequence because yesterday morning I noticed that the puts were worth $1.20 because of the dip in the market.
No, I don't trade it out of sequence. If I did that, you guys would become a slave to your computer, unfortunately. And the other thing is, the put was worth a lot, but if the market had fallen lower, then all of a sudden, your protection would have been gone. So you would have missed out on some. The bottom line is we don't want to sell that put until we're ready to roll over the trade, because then you're going to be at a huge risk. And if you do watch the SPY, it's nice and easy on you for quite some time. And then you wake up one day and it's down 5, 10, 20 bucks from the slightest negative news. So it's super sensitive. And so, yeah, bottom line is we just want to stick to the trading plan. Sure, if you had sold that put yesterday and then it bounced back today, you would have made a little extra money. But on the other hand, if the SPY had crashed 5 bucks, you're trying to pick up $1.20 on the put, and then you end up $5 short on the underlying. Does that make sense?
Yep.
So yeah, number one, we want to keep the program passive, not have you guys rushing to your computer because we're sitting on a big loss. So we always want to have that put option long, and only close out the put when we're going to open a new put right after. That way you're always very protected. I know it seems like the SPY has just gone straight up this year and it's invincible, but rest assured it's absolutely not. And people were probably thinking the same thing in the 1980s into the 1990s with Japan's stock market. And that thing was going straight up, and they had a lot of similar problems as the United States. And now it's 30 years later, and it hasn't gotten anywhere near the high in the 1990s. So yeah, this year's been easy. You could be a monkey and throw a dart at any asset class you picked, and you made some money. But that type of environment doesn't last for very long. So we've been playing it safe, and I wouldn't change anything we're doing. Hey, Dean, how's it going?
Good, bud. How you doing?
Doing great.
Nice. And William, great question though. And keep them coming, please. I know you just started last week, so anything that comes up, just please feel free.
Oh, sure. Yeah, no bad questions. And a lot of people have asked the same question before. We got a few new people joining in. Now, if you weren't registered, you're coming in as guest. Welcome. If you just joined, I'd love to hear from you. Let's find out where you're from. And let's see, who else has their phone unmuted? Sat Pudi, do you want to say hello? And maybe you can teach me how to properly pronounce your name. I apologize if I butchered that.
And folks, just real quick, so if you kind of scroll down to the bottom of your webinar screen here, if you scroll down and look to the left-hand side of the screen, the bottom left-hand corner, you're going to see a microphone, and you can click to unmute or mute that microphone. And please feel free to to say hello. My name's Dean Gallagher. I'm checking in from Albuquerque, New Mexico, and I've been investing for 16 years. If you guys want to just some basics so we kind of know where in the country you are, your name, it'd be greatly appreciated.
Now we've got one of my oldest clients just hopped in. Shout out to Steve Lane. How's it going? See if he's got his microphone out today. Let's see. We have a few new people in here today. So we have Sat Pudit, new member or a new person on a trial. We have B. Taylor. If you have a microphone, we'd love to talk to you. We find that if you do start discussing the strategy, you get a lot more out of the webinar than just listening. And Monty Grass, I think I've seen that name a few times. So welcome. If you have a microphone, we'd love to chat with you and get to know where you're at with the program. We got a new fellow joining in, Galaxy A10E. Welcome if you have a microphone. In fact, you're doing good, Steve. That's good to hear. Very good to hear. Guest, you got your microphone open. Say hello.
Hello.
That's Galaxy who just said hello. Where are you calling in from, Galaxy?
Florida.
Florida. All right. We have quite a few members in Florida, actually. Now, how long have you been following our videos, our emails, and such?
I'm new. I just started.
Oh, you just got going? So you saw the YouTube ad about selling covered calls on the SPY, I presume?
Yes.
That caught your interest? Okay, good. Well, this is not a sales pitch webinar. This is actually a webinar our paid members are in. So it's pure content. And we're going to do our best to teach you how the program works and get you on track here. We got a new guest. We have 4 guests coming in. So I see one of you guys have your mic unmuted. Please say hello. Would love to hear from you.
Okay.
Now, Galaxy A10e, let me ask you this. What does your portfolio composition look like right now? Are you all in on stocks?
Pretty heavily mixed, but I'm hedged everywhere, so I'm okay, except no options.
Oh, okay. So you have what, the typical stock bond portfolio, or what are you working on?
Mostly 80-20, 80 stocks, 20 bonds.
Okay. And what part of the bonds do you have, the front end or the long end?
Mixed, medium term and long term.
Now, are you doing corporate bonds, sovereign bonds?
Corporate bonds.
Oh, man. Okay.
Yes.
You're counting on that business cycle cranking on another year or 2 here then, huh?
I believe in the next 18 months, yeah.
Okay. Well, we'll talk a lot about how long the business cycle can go. And I like that prediction, 18 months. I think we're going to have a little volatility before we get there, but.
Yeah.
Now, you have any gold?
Very little, maybe 2-3%.
Okay. Now you said you're hedged. Now, how do you feel like you're hedged if you have no options in your 80-20 and all corporate related products?
You're right. I'm not properly hedged. You're right. I shouldn't have said hedged. I'm doing the TVIX. I'm playing the TVIX almost weekly to give me a little more protection on a daily or weekly basis, but that's about it.
Okay, great. Now I do have a question in from Steve Lane. On portfolio hedges, do you suggest shorter term hedges or longer term? So Steve, on the main advisory service, as you guys have all noticed, I've been very defensive for the past 3 months. So we've been generating slightly below our 1% target. And again, if there is a obvious pothole in the road and we can see it from a mile away, we're going to play it safe. So the portfolio is already extremely hedged. It's hard to make or lose money with our current setup. In our boot camp, though, I have been putting out some long call options on the VIX, which I know Steve and I did some fun trades a few years ago, mainly shorting the VIX actually. But this time around, I think you want to be long the VIX. So we're up a little bit on that. In general, our TLT position is our big hedge, and then GDX is the second hedge. We got a lot of people joining in. This is great. Let's see, we've got a bunch of people who are on the guest name because you joined from the Trade Alert email. Just a heads up, tomorrow, if you want to join our webinar, there's a Zoom email that does come to you, so you can get in an hour early compared to when the Trade Alert does hit. Let me pull up our trade today. We'll go over this in a minute. Now, real quick, for those of you who are already paid members, I want to service you first. Do you have any questions about the current trade setup that we're putting on today? And we have 18 people live now. I think our record was something like 25 or 30. We don't try to mass advertise this program. We don't have a sales letter. All we really have is free trade alerts, and that really is what has sold the program, and plus the content we provide on the daily video. So let's see. William, do you have any questions?
No, not right now. I'm good.
William's been one of the best folks asking questions, so I do appreciate all the input you've given to the program.
You're
so
welcome.
I appreciate that very much. Now, Steve, did I answer your question about, I'm not sure yeah, so I got in our boot camp program, Steve, which you might like, because we're doing some futures trading, some Forex trading, and also some VIX call options. So we're basically doing the more aggressive speculative hedging in our boot camp program. But right now I'll just give out one free trade to everybody just in our normal advisory. We have a 35 call on the VIX expiring in April, and that's one call option per set of 100 shares of SPY. And that's just trying to get a little extra oomph in our portfolio with very little risk. Really, the TLT is where I think we're going to make a ton of money in the next few months. And we'll take a look at the treasury curve and all that so you can see how it can play out.
That's a naked call?
A long call, yeah.
Long call.
Yep. And you actually get the...
On the TLT?
No, on the VIX. So William,
Okay,
you should be getting the free 30-day bonus for the boot camp right now. You are, correct?
Yes. Yes.
Okay, good. So Monday would be a good day to revisit that, and Friday we'll probably be adding to that position. In December, they did add a new option expiration.
Last Monday or next Monday?
Every Monday, I do a Q&A webinar with our boot camp members, and that's primarily just to review our open positions and to catch up new folks with previous modules. So we have some exciting trades. The Hong Kong trade is a really nice setup. There's almost no risk Hong Kong will strengthen its currency against the dollar, but there's massive forces depleting its reserves, not to mention protests. China's running out of cash. And we now have U.S. legislation that's putting pressure on Hong Kong. So the risk to reward on that's very nice. You can pay 19 cents a day to have a mini on the Hong Kong, shorting the Hong Kong dollar. And so I'll try to, if we have time today, I'll try to get into that. That's much more advanced. For now, the TLT is really where I see the big profits coming up for the next year. You know, going back to Galaxy with his 18-month prediction in terms of how long the business cycle may last. That's about how long I think it can go if everything is absolutely perfect. And we're talking no trade war escalation, no earnings declining, and no massive inflation coming up from, we're seeing inflation print hot worldwide right now. So the easy money making, just being long, just about anything is coming to an end soon. Today's trade is bullish. As you can see, we have somewhat of a loose option caller. We got the Fed meeting today. Unfortunately, a lot of you guys love all the screenshots I take every day and post for the news. Somehow, all the darn pictures I took today came out sideways. So I'll just summarize the hot news in a minute. Okay, we got a lot of people here live now. Let's see if we got any more. If you're a guest speaker and you have a microphone, would love to hear from a few more people. In fact, anyone who talks with me today, we're going to go ahead and give you a free week extension on your free trial. So Galaxy A10, you've got the free week extension. Let's see if we get a few other folks to talk with us today. Nothing like a good bribe, huh? Now, Galaxy, what's your real name, just so we make sure we get you hooked up here?
Jacob.
Jacob. Okay, I'll make sure Ryan knows. Okay, so I have Galaxy A10 was brave. He talked on the webinar. He gets a free week extension. Anyone else want to say hi and let us know where you're calling in from?
Where are you going?
And you can speak up at any point in the webinar. Let's see, Sat Puttit, you want to get a free week extension? Just got to turn on that mic and say hello, or talk to us in the chat box. Either one counts. So yeah, we got a lot of people live. I'll go ahead and get this program started in a minute here, guys. And if you did register, if you did log in from the Trade Alert email instead of the Zoom email, we don't know who you are. So you will have to let us know your email in the chat box so we can look up your free trial. So if you do access the webinar from the Zoom link every day, we've pre-registered you for the webinar during your trial. But if you're accessing it from the Trade Alert email, you're going to pop up with just a generic user. It's the only way we could get around that. All right, guys, I'm going to go ahead and get this show on the road and talk about our trades, how our portfolio plan works, and how to get the most out of this service. Any questions from any of our paid members before I get going? William?
No.
Come on, William. We count on you for all the good questions.
Not today. I mean, the only thing I haven't closed out yet, the trade from Monday, I haven't closed that out yet. So I have the full screen on, so I can't see Thinkorswim at the same time. So I'm going to have to wait.
Okay. Now, I think I saw Steve's microphone pumping some audio. Did you get your microphone on?
Hey, Jason.
Hey, Ron. How's it going?
Good. I noticed on your screen there that you've got the December 13th 312 put. I think in your alert you said 314.
I hope I didn't screw that up. Oh, my God. I've been just... Oh, guys, I've been making some mistakes on that. My apologies. Sitting at the fix right now.
So the 312 is the right one?
Yeah, 312 is correct. My apologies.
Okay.
Amazon here. It'll be on.
Okay, guys, we're getting that fixed trade out. My apologies. I really, it's a good thing we do the webinar every day. That way we make sure we get everything on track. So yeah, this is a bullish trade. We're buying the 312 put and we're selling the 316 call.
In your boot camp yesterday, you said that you should make your trade if you use your phone on the TD Mobile. Is that different than Thinkorswim?
No, if you have Thinkorswim, that's the greatest software platform I've ever seen for stock traders and options traders. But it's far more advanced than what our product really requires. When I was trading risky small cap stocks with limits and stop losses and things of that nature, Thinkorswim was a great tool. And when we're scanning hundreds of stocks, trying to figure out what's going to be pumped, things of that nature, I love Thinkorswim. But for our product, if you're new to Thinkorswim, you're going to feel like you've jumped into a F-16 fighter plane or something. But yeah, Ameritrade's 2 phone apps are beautiful for following our program. They have one for stocks and options and one for futures and Forex. And they make it extremely easy to follow the trades on the go. And I'm not kidding. We got 7-figure portfolios doing these from their phone while they're, in the train, on an airplane, at a restaurant, all over the place. So that is one of the sexier things to the product, is how hands-free and passive the program is. And now a common question I get is, hey, can I be trying to manipulate the trade in between the trading periods. We have had members pick up better profits than we've had. I see one guest has their hand raised. Go ahead and speak. Thank you for raising your hand.
Yeah, it's me, Jason Gary. I'm wondering, what are we supposed to do with the 314 put if we've already purchased it?
Just sell it. You'll get the same money back. You might lose a penny.
Okay, thanks.
Yeah, you might lose a penny or two, but nothing big.
Okay,
Sorry about that, Gary.
that's all right. It happened.
Yeah, that's my fault. I apologize. All right, guys. Well, if you do want to get a week extension, you got to speak up, hit the chat box, post your emails, say hello. We just want to get some interaction out of you. Okay, let's get the show going, and I'll be taking breaks to ask questions. Oh, wait, we got Jim Locke just joined in, Paul Sanchez. We got a phone caller coming in. We're up to 21 folks live. This is great. Thank you guys so much for joining us and taking time out of your day. Let's see. Jim, how's it going? You got your mic? Jim's a member. All right, guys. I'm going to go ahead and get going with the... Oh, go ahead.
Yeah, I couldn't get my mic unmuted there for a second. Yeah, I'm here. Things going good.
Excellent. Hey, good to hear from you, bud. All right, guys. Thank you so much for joining us live. We'll take breaks throughout this to ask questions. If I do hear too much feedback, I might mute you. Otherwise, I'm going to leave you guys mics live. So please interrupt me at any point. We've got all day. There's no other webinars today, so we can go for a couple hours. I found that most folks will let me talk as long as I'm willing to talk. And I've got a lot of content to show you guys. If I can, I'll even dive into some of our really exciting bootcamp modules, at least for a little teaser to review that for everybody. Okay, today's trade is to sell the 316 call option and purchase the 312 put. This is something in between our tight option caller and a loose option caller. And my expectation is that there's essentially a lot of gamma around the 315 call. So it's probably going to be hard for the SPY to go anywhere above 315 without a catalyst. And on the other side of the formula is that we have $60 billion a month flowing into the bond market from the Fed. So that's freeing up massive amounts of capital at companies like JP Morgan, Citi, Wells Fargo, Bank of America. They then in turn are lending this money to the hedge funds who have been goosing the stock market higher on super low volume. So as we do make it over to the, let's see. You know what, guys, I'm going to go ahead. Might mute us up for a second here. So the bottom line is we're in this melt up period. You could throw a dart at any stock, any asset class. Almost everything has gone up this year. But that easy money is probably coming to an end. We'll take a look at why. But bottom line is I love trading the SPY towards that 315 level. For those who've been following me for quite some time, we predicted 315 SPY something like $25 ago, right after that phase one trade deal. I do think we'll have substantial trouble getting above 315 until we get some clarity on the trade deal. In terms of what I think will happen with the trade deal, I think the highest probability is the tariffs go up, maybe not on Sunday, but potentially on Sunday, because we know that catalyst is what, 40 hours away, or let's see. We've got 2 trading days and then the weekend for the trade deal to either be signed, delayed, or for tariffs to go up. Tariffs go up, TLT is going to fly higher. Stocks will most likely tank for a short period of time. But I'm not willing to short stocks for a long period of time until we see the credit market snap, specifically the bonds that Mr. Galaxy's owning with corporate bonds. Second, those corporate bonds yields start to spike, I think we're going to have quite a chaos on our hands because the corporations won't be able to get free money from the bond market and buy back their own stock. So we're in a huge bubble. It's very dangerous. That's why we want to have that put option at the 312 strike. And actually, even though we're bullish on this trade, I would love nothing else than for stocks to tank by Friday. We'd lose a little bit on this trade, but we have much more to gain on the rest of our portfolio. If I do scroll down and look at our open positions, you can see we're long the TLT and can benefit up to 143. We have twice as many shares of the TLT as we have of the SPY. So there's $3 of run room on the TLT. And on the SPY, we can only lose 2. Now, because we have twice as many shares of the TLT versus the SPY, we really can make a lot more money from some volatility in the market right now. So we'd love nothing else to lose on this trade so that the rest of the portfolio benefits. Now, on the other hand, if it just kind of floats slowly back up, there's limited downside risk on the TLT and GDX because of what the central banks are doing. And that's lowering interest rates as slowly as they can get away with and doing massive quantitative easing, which they call not quantitative easing, simply because they're just buying the front end of the treasury curve. But the effect is that their balance sheet has grown $320 billion since their emergency meeting in September. And there's now a lot of people predicting some severe volatility to close the year out in the repo markets. Okay, so let's go from head to toe. For new folks, this is going to be your format of your trade alert every day. So at the very top, you're going to see your initial instructions to sell to open the 316 SPY call and to buy to open the 312 put. That's per 100 shares of the SPY. Common question is, hey, can I get away with not buying the SPY? Can I buy leap options, call options? The answer is no. The only way this strategy works is you're essentially acting like a landlord. And by owning this property of 100 shares of the SPY, it gives you the right to sell call options for income and also in some cases for simply to finance our downside protection. So I call selling call options something like taking candy from a baby, whereas buying put options a lot like buying health insurance. So both are very beneficial if your goal is a low volatility strategy, which is obviously the downside to this is we're going to make less when the market goes up, but when the market goes flat or down, our strategy greatly outperforms just about everything under the sun. Okay, the next thing you're going to see in every trade alert, besides the risk graph with this link to this webinar you're on, is you're going to see the results of the previous trade. Whether it's good, bad, or ugly, you get to see it. And we're all getting very, very similar results. Why? Because we're all trading at the same time and we're trading the most liquid products in the world. So the SPY is by far the most heavily traded ETF. Second place would be the QQQ, but that's just about the same as the SPY. Third place is your EEM ETF. If you're not familiar with that, that's the emerging markets ETF. The SPY has the top 500 American companies. Emerging markets has the top 1,000 Asian companies, excluding Japan. TLT is your bonds, so it's the 20 and 30-year treasuries. It does not have your notes or your T-bills, so it's not doing the front or middle of the treasury curve, but really just the long end. We like the TLT because it's the most sensitive to changes of interest rates. So we're actually playing the TLT as a buffer for the rest of our portfolio. And in this presentation, I'll show you the relationship between the SPY and the TLT and why when you own both in equal proportion in terms of dollar value, it makes your portfolio very weatherproof to volatility. GDX is the gold miners. We were playing GLD most of the year, expecting the Fed would have to capitulate and start lowering interest rates. And sure enough, they did. After they had done that and drove the spot price to 1,500, we've been playing GDX. It's been a bit of a slow couple months on GDX, but my anticipation is this can go significantly higher. Most likely well above 66, which is where it went in the last financial crisis after we did QE1, QE2. So you get the calculation of our open position every day updated. Now you could do this yourself. All you really want to do is track what was the price of the asset when I entered the position and what's the price when I exit, or in this case, where is it at today? So on this example, you can see we actually have an inverted option collar on emerging markets. So we're actually positioned for emerging markets to go down by next Tuesday when we trade EEM. So you can see the underlying asset went up 38 cents. The short call, which we sold at 41, below the trading price, and the long put gave us a credit of $1.75. Now, because this has gone up in value, to close that out currently, we'd have to pay $2.22. So we're down 12 cents a share on emerging markets ETF right now. But again, Sundays when the tariffs go up, and you'll see in our program, if there's a dead obvious risk right ahead of us, we're going to play it safe. So this trade has very little to lose if emerging markets goes up. However, if emerging markets were to go below 41, we can make around 75 cents to $1 per share. And in that portion of our portfolio, which is about 10% of the total assets, that's upwards of a 2.2% return in 1 week. Meanwhile, our maximum risk is half of a percent, so 0.005. So that's a very tight option collar, very little to lose. But if we get some volatility because tariffs go up on Sunday, this trade could be highly profitable on Tuesday. TLT is trading at 139.74, and we entered this position last Thursday at 139.08. Now, the problem with being too bullish on the TLT last week and into the following week is if the phase one trade deal really were to be achieved, my expectation is the SPY will break past that 315 level and apply more pressure to the long end of the treasury curve, which would mean TLT heads lower. So we paid 60 cents for some downside protection on the TLT so that at a minimum, if there was a phase one trade deal signed this week, which was a risk, but it does not look like that's going to be the case. So at a minimum, we would walk away with 138 a share because we have that put option right underneath our asset. And in this case, we sold an out of the money call option because if there is volatility, the TLT has a lot of movement to catch up with the front end of the treasury curve. This could skyrocket right back to 148 where we were in August, the last time Trump did the tariff threat. In fact, it might go far higher than that because in August, it was just a threat of tariffs. This time, it's real tariffs, and it's on $300 billion of goods that consumers buy, including our beloved iPhones. So I love the TLT. When we do get to our content after I review the trade alert, I'll explain why I think the minimum price tag for TLT is going to probably be around 180. So we'll take a look at that in a minute. Okay, the next part of the trade doc is your trading plan. So we trade the SPY Monday, Wednesday, Friday with 100 shares. Emerging markets on Tuesday with 200 shares. The TLT and GDX on Thursday with 200 shares. So bottom line is you have half your portfolio in equities between the SPY and emerging markets. And then you have half your portfolio in safe haven assets, the bonds and gold. Now, we're not just long these assets altogether. This would be a great portfolio to just buy and hold right now. But we're adding options to our strategy, which allows us to profit in multiple directions for each asset and really reduce volatility. Now, the downside is you're going to miss out on some of the big jumps from wherever we sell our call option. Now, a lot of members don't just trade $75,000. Most are trading upwards of $300,000, and quite a few are in the seven-figure portfolio size. So just multiply that. All you really need to remember is for every 100 shares of SPY, you want twice as many as the other assets. Now, at this point, I would like to take a quick break and see if we have any questions about this. And we got some more people joining in. Hey, Scotty, how's it going? I just noticed you joined and I unmuted your mic.
Hey, Jason, doing well. Hey, I haven't joined in a few weeks, so it's good to be on today, but really keeping up with you on YouTube. So I really like the trades.
Excellent. Thanks for the, any questions from anybody out there?
I have one. I keep getting rejected when I put in the trade on the SPY.
Okay, you probably need to close out the previous call option.
I did.
Okay.
And the only way I can get it to go through is to call Thinkorswim by phone and have them put it through manually. And I don't, is there something I can do that fixes that, or is that something on their end they have to fix?
William, is it specifically when you're trying to sell the call, or is it when you're trying to buy the put, or both?
When I sell the call, it says buying power effect is illegal.
Okay. Well, I'm wondering if you're able to close out your, I would go to your closed position tab and make sure you were able to buy back the short call we were in previously. That's usually what will prevent you from being able to sell a new call.
Now, can you help me? Where is the closed position tab?
Oh, I haven't used Thinkorswim since we were making a ton of money on penny stocks, scanning with Thinkorswim. And then Obama came in with a whole department just trying to shut down these penny stock folks. So I haven't looked at it in quite some time.
So William, all you have to do is go over to monitor, and you can see all your open positions. And then anything you see with the expiration of today, just close it out.
Okay.
Yep, and then just exit market and then enter market. Everything's always market in, market out.
Now, Galaxy, you're my guinea pig today. Does this trading plan make sense?
Yeah, it would even make sense if I stayed as a regular long position here. That mix.
Okay, so let me ask you this: what days do we trade the SPY with this trading plan?
Well, I'm in the SPY almost daily, but not with options, just with trading the SPY.
Oh, sure. I'm just I'm quizzing you on our trading plan from this chart. I just want to make sure you and other people following understand how our strategy works.
My question is, how does he protect his long spider position?
Yeah, how do we protect the long SPY? That's a great question. So yeah, let's go back up.
No, I'm not asking about how you do it. I'm asking the previous person that responded and said that he does not trade options, but rather just trades the SPY position.
Oh, I'll tell you how he does it. The second he sees it selling off, he runs for the hills. Probably, right, Galaxy?
Well, no, I do the TVIX and on the other side sometimes.
Okay, so he's hedging with the VIX, with ETN version of the VIX.
Okay, all right. But
well, yeah, that's one strategy.
In terms of not having to react suddenly, the option position combined with the long spider is a much more fluid way of handling your positions rather than having to overreact.
Absolutely. And really, I think the main part of what we do, guys, is we're structuring the portfolio just in general to have a lot of protection inherently built into it because of the way we're structured in risk off positioning with about half the account. Okay. And then to add another layer of defense security. So picture that as we kind of put you in a tank, right? And then what we do is we then collar the position you're in to basically give you, radar around your tank and some F-16 monitoring, right? So you literally can't, you put yourself in a parameter, and we're always at a 1 to 15% risk to reward ratio, right? So our whole thing is knocking down the amount of risk that we can have in the market at all times. And instead of being reactionary to a terrible event in the market, we're already set up to be okay with that. And if World War III started tonight, we'd wake up with more capital in our account tomorrow than we have today. And so that's kind of the general overall kind of 10,000 foot view. But yeah, much more fluid, just like you pointed out. So good analysis on that.
So, okay, so here's what I like to point out about our program. And also, this is how all the big hedge funds have made it to the top. They're not trying to outperform the SPY. And in 10 years of being in this industry, you know, my job for the last 10 years was actually rounding up all the best, most credible gurus you could find and marketing and managing their services. And what I came to find was a few problems in every single product we had sold. And we're talking about Chuck Hughes, Matt Hedge Fund Trader, James Bond, Timothy Sykes. I've sold all of their programs, and they'd be bragging about all this money they'd made. And so I'd go send our marketing team to call them all up and grab testimonials. And guess what? There was no testimonial. You'd be lucky to get a single testimonial out of thousands of people that bought these products. And so I'm here scratching my head wondering why their refund rates are so high. And that was obviously why people are just not getting results. So really quickly, I just want to kind of point out the benefits of our product compared to everything else and how it works, why it works. Why do we have no refunds in this program? Why do we have everyone getting the exact same results? Why is this so much different? So first of all, what I want to point out is we have a risk to reward ratio of risking $1 to make $40.65 in the past 12 months. Now, if you're trying to wing it on the SPY ETF, you have had 18% volatility just last December. You had 8% volatility in May, and you had another 8% volatility in August. So if you add that all together, you've got something like $36 of volatility and loss in your account to generate $24 of profit. So you're putting up more risk than you're making money by holding the SPY ETF. So it's really not a great strategy. In our program, we've had a maximum loss of 1% in a month, and that was in July, simply protecting against the trade war escalating. Now, guess what? In July, they came out, oh, we got a farm deal. Oh, by August, there's no farm deal. And notice in May, let's just go back to December, stocks fell 16%. Our strategy pulled in 1.2. May, stocks fell 8%. We pulled up 2.2% return. August, I really believed him. I thought we had a farm deal, but because of our strategy, we're able to pull in a 0.8% return from another 8% drawdown. So that's what really is important, is what's your risk to reward ratio? If you can risk $1 to make even $10, that's hard to beat. And so that's why this program has become so popular. That's why we can give it away for free and collect members every week. So we're up to over 165 members now, and it's not been accomplished by long sales letters or any kind of scheme. It's been given out with free trades and this same presentation every day. Okay, I want to continue on so you can learn how the trade alert looks each day. So at the top, you get the new trade. You're going to get this live webinar daily, where I'll tell you the thinking behind the trade. More importantly, I'm going to go put a bunch of calculations together every morning, telling you what your open profit losses on the other three assets. That can be a pain in the ass. I'm very good at calculating this every day. So you'll know exactly how each position is performing every morning just by opening up the trade email. Okay, now it is important to realize the way this is designed, these assets are all uncorrelated. The SPY and emerging markets are somewhat correlated, but they break paths all the time. The same is true for TLT and GDX. Now, if we can get the big picture right and generate profits over the long run in each asset, and then we overlap those returns, you get a very low volatility profit generating strategy. Okay, the next thing is I'm going to remind you the trading schedule. We only touch the SPY ETF Monday, Wednesday, Friday at noon Eastern. Now I want to go back to what I was talking about, other advisories bragging about huge results, but no one else is getting it. Well, here's why. Number one, first of all, you never know when the trade alert's going to come out. So unless you're like Galaxy and you're glued to your trading platform all day, you're not going to get the same price as the guru because you're just going to be reacting slower. Okay, that's number one. Number two, a lot of these other advisories are trading small cap stocks, medium cap stocks. They might be scanning what stock has the highest covered call today. That's always a nightmare. Or they might be scanning what's the highest paying dividend. I got news for you. There's no free lunch. The bigger the covered call yield or the bigger the dividend stock, probably the more money you're going to lose from the underlying asset. So we're trading the top shelf products, the SPY, emerging markets, TLT, and GDX. These are the best of the best in terms of building a diversified, uncorrelated portfolio. Next thing is I will never touch the position outside of the trading day and time. That's so important because now our entire group can count on all trading decisions being made at the same time on the same day. So that's the magic recipe for how we've been able to get our clients having the same result as our portfolio. And we're talking within pennies. I mean, Scott, what's your experience? I mean, whether it's winning or losing, are you getting pretty close to the same results as we are?
Yeah, I'm getting exactly the same results. And that was one of my main criteria coming into the program while I was on the trial. I tracked that very closely.
Great. So whether we're winning or losing, you're going to be getting the exact same results as us. The products are uncorrelated. It's the best of the best. You cannot get better quality securities that are more diversified. All four are uncorrelated. So you're going to typically generate at different times. Now, today's a weird day. Almost everything's gone up. And that's because we're in this funny world where central banks printing $60 billion a month and handing it over to JP Morgan and the like. And then they're turning around and lending it to hedge funds who are using 5-to-1 leverage to goose the market higher. We'll get into that in a minute. Okay, so let's look what comes next in the trade alert. Well, the next thing I'm going to do is break down our total return with all strategies combined. So once again, $1 of risk for $14.65 of profit. You can't beat that. Now, if I was Ray Dalio and managing a $140 billion fund, I could not use the same strategy we're using. And just a heads up, that we literally ripped this right out of Ray Dalio's playbook. Okay, and a lot of people have ripped off his strategy because he became the most profitable hedge fund manager of all time. And it's a simple bond stock strategy. Now you add the option callers, that's what he can't do. His fund is so large, there's no way he could go sell 10,000 option contracts every Monday, Wednesday, Friday. So he just can't do what we're doing. And I'll show you the relationship between the SPY and the TLT. Next thing I'm going to do every day is update the profit loss per month for each individual asset. Now this is just purely so you can see where the gains are coming in for each asset class. And as far as I know, there's no product out there that has anywhere near the level of accounting that we provide. So you can see here's our monthly return on the Monday, Wednesday, Friday, our current return. Now, the next thing I do is I kind of tease you with after this business cycle is ended and everything's crashed and we're at a reset. Yeah, I might take on a different set of ETFs. But, you know, I like Galaxy's estimate of 18 months of runway before a big crash. Now, trade war will escalate that timeline. No question. We'll look at that in a minute. But right now you can see our portfolio is hovering on the safest asset and taking advantage of those 3 option expirations a week. So it's all in on the SPY. Also, this same spreadsheet that you're seeing all of our calculations done on, we actually invested quite a bit of money to kind of create like a Tesla gigafactory, but for creating these spreadsheets. So all our members do have these. Not everyone uses it, but it is an option and something we provide. Okay, next we look at our results on the Tuesday trade. It has a higher year-to-date return. It does try to have a bigger return. What's the cost of that? more volatility. So while the SPY represents 40% of our portfolio, the Tuesday trade only represents 10%. So it allows us to take more risk, and the catch is we're going to have more volatility. So again, there's no free lunch. As we scroll down, you can also see that once again, after we have a global reset where credit crashes, stocks crash, rates go up, well, then that's a great time to take on some bigger risks. So we can actually look what's underneath the emerging markets ETF and really put it on steroids. We're not anywhere near that time point yet because we need to guard that position with put options at all times. Okay, next we have our bond portfolio. Once again, you get to see our monthly return. I want you to point out, or at least notice that if you look at any track record individually, there's 3 or 4 months of losses. It's only when you overlap all strategies together that you get this low volatility risk to reward ratio that's so hard to beat. Again, $1 of risk for $14.65 of profit in the past 12 months. Okay, finally, we have our precious metals. This is by far the riskiest part of our portfolio. It's had some insane returns. It's also had some pretty insane losses. Now, I do want to note that we've been gradually growing this position size as it's become more clear that the central banks are going into QE, massive quantitative easing. So in December, don't forget, Powell said we had autopilot rate hikes, quantitative tightening for all of 2019. What a joke. Market crashed on that news. And come January and February was the next meeting. He did the infamous Powell pivot, where he'll probably be made fun of that for the rest of his career. And since then, we've had 3 rate cuts and $320 billion of money placed into the central bank's balance sheet. Now, once again, we only want to play gold when there's easy monetary policy and potential for fear. After we do have a big reset, there's obviously some better metals we might want to invest in long term. So we're a ways away from that. Next in the trade alert, you'll see our returns against the S&P 500. I'm not trying to outperform the SPY. You want to go buy the SPY and hope you get lucky, go for it. If you want to have a low volatility strategy that generates safe returns, you can see when the market collapses, our portfolio does just fine. And so most likely the easy money on the SPY has been made this year. And I don't think 2020 will be anywhere near as easy for investors. We got an election. We've got a trade war with China that's going nowhere. We've got inflation picking up all around the world, which forces central banks to increase interest rates. So there's a lot of wild cards coming at you. Again, in August, I was ready for trade war to escalate in July. And they came out and said, hey, China's going to buy a whole bunch of farm product. Now, that sure didn't happen. By August, he did escalate the trade war, completely caught us off guard. And it's ever since that I've been playing it very safe, because December 15th was the deadline. And so we've made it. We're 4 days away from the deadline, and we can show you how our trading plan will react to the news. Now, next step is your step-by-step trade alert instructions. This is just a visual of how to get in and out of the positions. So step 1, if you took the previous trade, you do step 1. If you didn't, you go straight to step 2. This just makes it very easy for new folks to follow the program. I call these trades atomic bomb proof. And that's because North Korea could go fire a nuke, which they've actually been threatening to do in the last few weeks, at least test them. We could have a complete stock market crash. And because we are buying this long put, you will get that price tag on your SPY share and every other asset we own. We have a put option below all 4 assets at all times. Now, does that create a drag on profit? You better believe it. So these returns are achieved predicting the direction of each asset and then having to have a drag on it. So that's how well this big picture strategy works, is we can actually have these huge drags on our gains and still have this 15-to-1 risk to reward ratio. So once again, all assets always have a put option below. It's a big drag on return, but the bottom line is you're ultra safe. If any one of these assets collapses tomorrow, you're not going to lose a lot of money. You're going to get whatever the strike is on our put. Now, Galaxy, do you have any questions?
No, I'm at all. Yes, it's a different philosophy that I'm learning right now.
Okay. Yeah. If you have any questions. Okay. So that's your trade alert. Now it looks exactly the same for emerging markets and for the TLT GDX. The only difference is you'll get 2 trades on Thursday. So a little more work. But again, these trades take a couple minutes and you're done. We will not touch these for any reason under the sun outside of our trading period. So that makes it passive. It makes it easy to follow, and it ensures you get the same result as what we're publishing. And that's whether it's good, bad, or ugly. I think when people can see that we're not another thing I've seen from other advisories, they'll be bragging that they've never had a losing trade. Give me a break. What do? They close out winners and brag about it. And then they just put all the open positions that are losers. They sweep them under the rug. Same thing you did as a child to not put away your dirty clothes. So there's no hidden trades. This is an extremely transparent program. Okay, so that's a review of the trade. Now I want to kind of teach you the philosophy behind the program. And so, there's a bazillion different indicators, that you could be looking at. I'm going to simplify it for you so that you can understand how we predict the market and how our trading plan will react to really 3 circumstances I see in the near future. And now this is a little bit of our $10,000 bootcamp program, which you get a free month in if you do upgrade your free trial. The easy way to predict markets and generate safe income, daily income trade alerts at noon Eastern. Here's our trading plan. You guys got that down pat. Our goal is to generate 1% a month. We've averaged 1.25. Again, if I see a huge risk in the market that's a month or 2 away, I'm not going to be sad if we just tread water for a few months. I'd much rather tread water, break even, have a small gain than risk taking on a 2, 3, 4, 5% loss. And again, our biggest volatility was only 1% in a period of a month. We've had profits in 11 of the past 12 months. Largest drawdown is 1% in a single month. And we've never lost capital over a 90-day period. Okay, we've all seen this. Our simple 4 ETF portfolio is extremely diversified and all you'll need for your retirement. Income and safety, not growth or speculation. So you can simplify your holdings, reduce your risk, get better results with less work, and weatherproof your retirement portfolio. Now let's talk about how we can alter the trading plan depending on what's happening in the biggest catalyst we have. Right now, the biggest catalyst outside of the Fed, who I believe we have a pretty firm grip on what they're going to be doing, which is gradually lowering interest rates because there's low inflation and doing quantitative easing. So that's the single most important thing I track, or what are the central banks doing? After that, the second most important catalyst is the trade war. If the trade war is up in the air, that's essentially our setup to be long SPY, emerging markets, the TLT, and relatively tight on gold. I don't think gold will go down when the trade war is up in the air. I just don't think it's going to appreciate much for us. And I'll show you how we optimize the options contracts based on this setup in a minute. This is where we're at right now with our portfolio. We're long everything, but we're tight GDX. Now, guess what? The second the trade war escalates, we know exactly what will happen. And it happens every single time the trade war escalates. Stocks go down, bonds and gold jump up. And also, I do want to shout out that if you have any questions, to save Dean's phone number, it's in the chat box, and I'll have it up in a minute. Okay, so what happens when the trade war escalates? It's an immediate reaction. Stocks tumble, bonds and gold go up. Now, we're not going to sell the SPY or emerging markets. We're going to make a buttload of money with our options, and I'll show you in a minute. It's called the inverted option collar. Under no circumstances are we ever going to sell these positions. This is our trading plan. We use the option market to manipulate the profits depending on the direction we're predicting. Now, I want to point out that even though I do think stocks will sell off the second the trade war escalates, I still think it'll be a short-lived sell-off. And that's because the Fed can still lower rates from 1.75 down to 0. So they still have the potential for about 7 rate cuts. And if they drag that out every 3 months, you land at Galaxy's prediction of 18 months. Now, the problem with that is if the trade war escalates, they might start cutting quicker. And the second we get to 0, there's a big problem for the bond market. And it may actually, before we get to 0, people might start to figure this out. I'll talk about that more in a minute. Now, the exact opposite happens. Just go back to October when they came out saying, hey, we got Trump on TV saying, hey, China is going to buy $50 billion of farm products. They said so. Okay. So that's what they said back in October. What's the immediate reaction? Well, we saw the TLT and GDX sell off and stocks rallied higher. So if we do see a phase 1 trade deal, you better bet your bridges that we're going to be optimizing the options so that we benefit from the SPY and emerging markets going even higher and for the bond market to have a short-term sell-off. Now, again, the TLT and GDX are going to go higher because of the big picture of interest rates going lower and quantitative easing expediting. So again, it would be a short-lived sell-off in bonds. And we'll take a look at that in a minute. All right, so here's our 3 types of option trades. We do the bullish loose option caller. This is the riskiest trade setup we have. We're selling an out-of-the-money call and we're buying an out-of-the-money put. In this setup, we can lose or win about $3 a share, or about 1%. So in this setup, our options will lose money if we're correct, and the underlying asset delivers the profit. Here's our neutral tight option caller. Now this one, we're going to generate all the profit from our call option, and we're still going to have downside protection. So right now, if the SPY were at 315, say on Friday, which is where I think it will be, so today's trade was this one, a little bit tighter. We need the asset to go higher. If we hit 315, 315.50 on Friday, this will be the trade. Okay, so this reduces our downside risk to $1, but if we just trade flat, we pick up $1 profit, and that'll be from the covered call we've sold. The final trade setup that most investors are completely unaware of, and as far as I know, I made up the term inverted option caller. We sell an in-the-money call and we buy an in-the-money put, and we can actually own the asset, take advantage of collecting huge premiums selling in-the-money calls, and then buy an in-the-money put. So we actually generate a profit with this setup if the asset goes down. Now note, if we bet up, the option market is not on your side. You get a 1-to-1 risk to reward ratio because that's what the market normally does. Okay, and the tight option caller, same thing. But the second we're willing to bet down, we have a 2-to-1 risk to reward ratio. So this is the best way to profit from a down move in the underlying asset. It's just not very often we get to put these trades on. So
Hey,
if
Jason,
you're trying to hedge your
Galaxy
SPY
10.
position, this is the best way to do it. See, I see a phone caller with some audio. You got a question?
No, we're just getting a lot of background noise for Galaxy 10. Can you mute him real quick, just so we?
I think it was actually this 3
No, it was him. It was him, dude.
Now, Galaxy, got any questions?
No, I'm pretty quiet here. I don't know what noise. It's not coming from me.
No worries. Well, let's see. We got a lot of guests on here live. Any other questions so far? Who can explain how we make money? William, how about you explain to the crowd, how do we make money? How on earth does this make money if the SPY goes down? How can we own the SPY and make money with an inverted option caller if we're headed down?
You're putting me on the spot here. I mean, it seems like when you explain it, I understand it, but to explain it back to somebody else is probably not a good idea.
Well, let's walk through it together. Okay, so in this example, and this is going to be the most important trade for all investors in 2020. Okay, because there's volatility coming. This is your best friend right here. So let's walk through it. What price is the SPY at? Let's round up to the nearest dollar in this chart. What's our trading price?
298.
Okay, now if I sell a 297 call, what exactly does that mean?
It's in the money.
It's in the money.
So
What am I basically agreeing to with the option buyer?
you're agreeing to sell the stock for $1 loss per.
Correct. Now, why on earth would I agree to sell my stock for $1 loss?
Because you got the premium.
Right. Now, how much premium am I picking up on this one?
Looks like 219.
Yeah. So what's the net let's forget about the put option we're buying. Let's just say the market went higher. The option buyer decides to exercise his right and we're assigned. What's our net profit on the long side of this trade?
227 plus $1.19.
So we're going to pick up 220. We get to keep the option premium. Now, are we making a profit or making a loss on the underlying?
A loss.
Loss.
Okay, so we're gaining 220, but we're losing $1. So what's our net profit on that one?
120.
$1.20. Yep. Okay, so that's how we're going into the trade. But if we just did that and the SPY went lower, it never generates a profit. The SPY will lose value faster than your covered call can ever protect you. Okay, so what's the next part of the trade? We're buying a $300 put. So wait, that means some fellow is willing to buy our shares for $300 a share, but they're only worth $298. So what? Let's see how that works out. So if that guy is willing to pay me $300 a share, and that's $2 worth, $2 more than they're worth. Well, what am I having to pay for that? Right. Well, I'm paying about 27 cents. So I'm getting an extra $2 if I were to exercise the put, but I had to pay 27 cents of premium. Essentially, I want this to go down at least 27 cents, and I'm starting to make money because I'm generating a profit on the call, and now I'm making up the premium on that put. So again, in our boot camp, we'll go over this in great detail and spend about 2 hours just going over this in every angle possible. But the bottom line is, if you sell an in-the-money call, you get a huge premium. You turn around and buy an in-the-money put, and you're set up to have almost a risk-free way to bet down. You're letting the call option finance the put. And this is going to be your best friend the second markets get volatile. Okay, let's go ahead and continue. All right, so how are we predicting the direction of these assets? The good news is they're very tied into really one thing, and that's what the central bank is doing. Now, sure, can we get some short-term volatility in these assets from something like trade war, maybe earnings going lower, inflation fears? Sure. Maybe a big bankruptcy of a big bank from the repo. Of course, there's a lot of different things that can affect the markets. Okay, wait, I got a question from Steve Lane. If we expect down, why not do this trade today, financing the put with the call, if the market goes down? Because the TLT is ready to win for us, Steve. If it doesn't happen, we don't want to just lose on both sides of the trade. So most of the time we're going to be, unless there's a real catalyst to bet down on the SPY, I'm not going to do it. And why? Well, we're about to see why. Okay, so number one thing to look at is the Fed adding to the money supply or depleting the money supply, because that makes the biggest difference in markets by far. Now, 10, 20 years ago, they would have said you're a crackpot to believe in this. Now it's just common understanding that this is the biggest mover of markets. And what's also interesting is these different central banks collaborate and kind of take turns pumping up the market. So whether it's Japan, Euro, or America, they're literally rotating, taking turns to print money to keep this bubble going. Right now we have the ECB and the Fed printing about $100 billion a month currently. Now, where does that money go? It's not going straight to stocks. They're buying right now the front end of the Treasury curve. And guess who loaded up on the front end of the Treasury curve for the last 12 months? Yeah, JP Morgan. They actually have purchased 25% of all government debt. And they're, they have to, they're a primary dealer. But what a sweetheart deal that, they're buying massive debt as Trump creates massive deficits. The Fed artificially lowers yields on bonds, which makes their prices go up. And now the Fed's buying those bonds from JP Morgan. In fact, they're flipping bonds within a week. The Fed's supposed to buy old treasury, old debt. They're not supposed to be manipulating the treasury market. But we can go look, and they're purchasing freshly printed debt. So it goes from government to JP Morgan, and then a week later to the Fed, and they're making money hand over fist. Okay, so we know the bond market's being supported. Because the bond market's being supported, the banks are making huge profits, which they're then lending out to hedge funds to use a lot of leverage. And they're doing the same strategy we are. They're leveraging up on stocks and bonds. Now, because they're so big that they can't do the call options and the put options like we can, they're simply using leverage to get the same effect and pushing more money back and forth between bonds and stocks. And because of that relationship, they can get a very low volatile return just like we are. Okay, now we have a question. Isn't a lot of the money the Fed is investing come from old QE instruments coming due? Some, and that's what they're supposed to do. Their website says they're supposed to only buy really old debts. But they're literally buying the front end of the treasury. We'll look at the curve in a minute. You can just see how much they've artificially pushed those rates down on the T-bills. So the T-bill is anything under a year. But yeah, they're buying freshly printed debt right now. So this is not what they're supposed to be doing. And they call it the Federal Reserve. There's nothing federal about it. It's owned by the commercial banks. Okay, number two, is the Fed increasing or decreasing the cost of money, raising or lowering interest rates? Now, a lot of investors I speak to, they're concerned about having to realize the huge profit they've generated over the last 40 years. And in their lifespan, they've been able to live through 3 big crashes, 1990, 2000, and we'll round up to 2010.
JP Morgan.
Basically, their thought was, well, I could pay my tax, upwards of 50%, or I could just let it crash 50% and come right back up. That's what a lot of investors are thinking right now is I don't want to cash out because I don't want to pay any taxes. Okay. But what I want you to see in this graph is the magic that has made the market recover each time is being able to reduce the cost of money. Okay. So Paul Volcker passed away, I think not yesterday, but the day before. He's the man who pushed rates to 20%. Okay. And if he had not done that, we would have not gotten all the malinvestment out of the economy we got out of World War II, and there's this sense of relief. Everybody wanted to spend money. The governments wanted to create all these social nets to protect all the poor people. And, we went into a Cold War with Russia, just spend. Well, the stock market sure loved that. We had a huge stock market rally from 45 to 65, but then something broke. Okay, and all that government spending, which was goosing up corporate profits, you had this, look at 1955, 1960. You see that rate go up to 2.5. Oh, can't do that. We got to crash. Went right back to, at that time, zero was basically not zero. It was a little bit higher. They tried to get rates up again. We got another crash. And then inflation started piling in. And what did we have to do for the next 15 years? Paul Volcker jacked that federal funds rate, the cost of money, much higher. Now, let me ask you this. If you have to pay an interest rate of 10% a year, do you think Netflix would be around right now? Hell no. Would Uber? Would any company that loses billions of dollars a month for years on end be in existence right now if they had to pay 10% a year interest? Hell no. Okay. And so that's what happens. You print too much money. It finally gets out of these asset classes. You get inflation. And we're in this weird world where because Janet Yellen, good old Janet, put our rates at zero for the better part of half a decade, that's allowed corporations to have a business model that essentially borrows money for free. Microsoft can actually go to Europe and get paid to borrow money and turn around and buy their own stock. Okay, but we have a world of corporations that are borrowing massive, massive amounts of money, billions and billions of dollars. If you combine them all, trillions of dollars worldwide, and they have very low interest. And so they're not incentivized to generate a profit. They're incentivized to compete with other corporations who have free capital. So what's the result? They're selling goods at a loss. Now, no wonder the inflation rate looks so low. The corporations are fighting with each other and they have free money. So it's driving the cost of goods down. So this will implode on itself. But the big picture here that you need to realize is that we did this in 1955, 1960. We bounced interest rates around zero for a while. We got massive misallocations of capital, all kinds of scams going on, unprofitable business models. And eventually that turns into inflation you just can't control. And that's where you get 15-year bear market in stocks and bonds. And so the magic that has allowed the market to recover in the 90s, in the 2000s, and the 2010 era was the ability for the Federal Reserve to decrease the cost of money. And each crash was the result of, well, first of all, trying to increase rates. But once they saw they had created a recession, the Fed's not dumb. What do every single time? They start cutting interest rates well before the recession hits. They're very, very good at predicting recessions, despite all the critiques they get. And so you can see they're cutting into these gray lines. Those are your three last recessions. And sure enough, they knew it was coming, but they saved the day by cutting rates by around 5 to 7%. And then after they cut rates, they did quantitative easing. So essentially let the banks buy government bonds, make a huge profit into the crash as they drop rates. And then the banks get bailed out with QE. And what do? They turn around and buy stocks half off. So that miracle has worked 3 times over the last 4 decades. The problem this time is we can't cut rates 5%. We're starting at 2.5%. And now we're doing QE and rate cutting at the same time because they know they're out of ammunition. So most likely the next run up in stocks will be the last because we're going to go to 0% rates and there's no more room to cut it further. So we're probably headed towards a period like 1965 through 1980 and not something like the 1990s through 2000. And it's just because the Fed cannot cut rates. All they can do now is quantitative easing. And eventually inflation ruins it all. Now, the bad news is inflation in China is at 4.5%. That is awful. Brazil just had some high inflation numbers. The US inflation rate just peaked up a little bit. So it's coming. All right, now next, all you got to do at this chart to get the big idea of why this strategy works, why does Ray Dalio do this? Why do all the big hedge funds do this? Stocks and bonds have a correlation. When stocks sell off, money flows into bonds. It's just that simple. And so you can see whenever the green line, which is your SPY, tanks, what happens to that orange line? It goes up. Now, what's more interesting? Both of these assets have gone up together over time. So this works as long as the Fed can artificially push bond prices higher, but they run out of rope once we get to zero. So the size of the bond market is about as big as it can get, and it will end once we hit zero. Now, could they bounce it up and down? Sure. And we could look at what Japan did. That's exactly what Japan did. Japan decided, if you go back to 1980 through 1990, Japan was going to be better than America. They're all over Time magazine, how to deal with Japan. But what happened? Their real estate skyrocketed, their stock market skyrocketed, cost to deliver goods in Japan went rocket high. And so all the corporations got the hell out of Dodge. There's cheaper labor elsewhere. And what was Japan left with? A super expensive real estate market and so much debt. They don't know what to do with it. So what did they do? They protected their exports. They protected their currency at all costs. And now the Japanese government owns 60% of all Japanese assets. So what's the result? 30 years of negative returns on their stock market. They haven't even got back to the value of 1990. Real estate's down 20%. People are negative on all their mortgage loans. And so that's what they decided to do. Let's just stabilize our economy, keep our currency strong, and at the cost of real estate and stock market crashing and never recovering. So it's a good question. Will the United States pull that, or are they going to have some balls and hike up interest rates like Paul Volcker did? And so that's the big discussion going on at the Fed right now. Anyway, what's important for us, at least while we have a little rope left, is that we can rely on this stock bond relationship to deliver very stable, low volatile returns. Okay, now this is a look at your TLT all on its own. I just want you to note TLT is pretty boring. I call it the slow bleeder. It slow bleeds and then it rockets higher. So it's slow bleeding against the stock market, gradually going higher. And then when stocks suddenly crash, that's when our put options kick in and the TLT delivers the gain. So when Steve asked me, why aren't we betting down on the SPY today? Well, because if I'm wrong, stocks are most likely to go higher. So I don't want to miss out on that. And if I'm right and the trade war escalates, TLT and GDX will deliver a big gain and the SPY losses will be cut off the second we hit our put strike. Okay, now I'm just going through history. All you got to note is one goes up, the other goes down. In general, they're both traveling up. And again, this only works until we get to zero on the federal funds rate, which they're trying to do as slowly as they can. The problem is, if the trade war escalates, we're going to hit zero much faster. And so you can see the dance between the TLT and the SPY. That's how we generate these safe returns and low volatile returns without really knowing what's going to happen in the future. Now I'm doing my best to predict that, but in August, I took him for his word. I thought we had to deal with China to buy agricultural products. In August, he shocked the whole world. No, we don't. Okay, now we do. Now we don't. Now we do. Now we don't. You don't need to predict what's going to happen if you have the right ratio of stocks to bonds. Okay, so you can see this correlation continuing. Now, when the Fed is aggressively cutting rates and printing money, both assets go up rapidly together. And so you can see the SPY is barely outperforming the TLT over this stretch of time. Now, how does gold play into the portfolio? Well, gold is super volatile, and I would love to short gold right back down to low levels. It's just not coming soon. Right now, the Fed is buying treasuries, cutting rates. That's very bullish for gold. The only thing it needs for a big pop higher is fear, which I do believe we have coming. Now, once again, once the Fed starts to rise rates and do quantitative tightening, gold sinks like a rock. And we can use that inverted option collar to profit from that. Also, gold and bonds do have a high degree of correlation. But once there's the fear of rate hikes, first you see bonds crash and you get another pop in your gold. So they're not completely correlated. And it does, again, add two different types of protection against volatility in our portfolio. Now, I like gold miners better than GLD, spot gold. We played spot gold expecting quantitative easing to begin and lower rates. Now that it's already officially occurred, a lot more money to be made in gold miners. So GDX does that for us. If we go back to the 2009 crisis, we got to $60 a share, 65. I think it's going far higher. The big picture is that China has misallocated trillions of dollars, probably 10 times worse than what we saw in 2008 housing bubble. And we're seeing that China is slowing down. And that's what's going to cause the next big recession. What's in the SPY? It's a $262 billion fund, and it trades $20 billion a day. It's the only ETF with 3 option expirations a week. It's loaded up on tech and finance primarily. And these are your big companies. So one share of SPY, you've got all the best American companies. And what's more important about this is these are the companies who have access to cheap credit. so they can buy back their own stocks. Plus, they're getting most of the money that flows through the SPY. Emerging markets is 1,000 companies. It excludes Japan, but it has primarily Hong Kong, which is China, South Korea, Taiwan, India, Brazil, South Africa, Russia. So it's really a very diverse block of companies that we have access to with the emerging markets. Most important companies are Alibaba and Tencent. But you also got Samsung and Taiwan Semiconductors. Why do we want to have access to China? There's a lot of people. Something like 2/3 of the world lives right in that spot. So there's a whole lot more customers to be served. Is there legal structure garbage? Sure. Is there lots of corruption? Sure. Is accounting bad? Sure. But do they have huge growth potential? Yes. They are growing rapidly and definitely deserves a part of our portfolio if we want to truly be diversified. All right, so your top companies in GDX are Newmont Gold and Barrick Gold. The problem with all your junior miners is they don't have any money to actually mine. They just run investor relation ads, take your money, pay management, and go buy some more investor relation ads. They have no intent to actually mine any gold. These are the companies who have access to capital to mine gold and flip it to the central banks while we have time. All right, guys, that's a big overview of the program. At this point, I do want to mention that if you do upgrade your free trial, we're going to give you 1 free month in our $10,000 boot camp program. So if you do like the content you've been learning today, that's just the tip of the iceberg. So definitely save Dean's phone number, 505-322-7515. This way you can give him a call, ask as many questions as you like, and get a firm grip on our program and maybe upgrade. Now let's see if we have any questions before I continue, as I do have a lot more slides we can jump into in a minute. Let's see. Steve says, I used to run a company when rates were low. We always used cheap money for acquisitions and CapEx, free candy, even secondary markets had cheap debt. Problem goes in when refinance comes due and Fed have raised rates. Yeah. The second the Fed raises rates, we're going to have a heap of trouble on our hands. Absolutely. So they're going to try to drag that out as long as they can, for sure. Let's see. I see one guest with their microphone unmuted. You want to say hello? Have any questions?
You may be talking about me, but I have a lot of interference here, so I just put it all on mute.
Oh, no worries. So what are you thinking so far, Galaxy? You have any questions?
It's too much that I'm trying to digest quietly because of all the interference I have here. So I'm listening.
Okay, great.
I'll put it back on mute. Yes.
Okay. All right. Well, I'll go ahead and continue unless anyone has a question at this point. We still have 18 live, so keeping our audience. That's great. Thanks for listening thus far. All right, let's continue. So when does the long bond stock strategy break down? Bottom line is rising rates kills the fun and also ending quantitative easing. But mainly raising interest rates is the biggest problem. Now, what actually causes central banks to rise interest rates? Well, they try to do that when they think they can get away with it because they know that's their only ammunition to fight a recession. But there's a few points in time where they've had to raise interest rates and it was terrible timing. Okay, so we're going to take a look at that. This is a picture of the Dow. So once again, investors have been programmed that you can buy and hold, live through a recession, and avoid paying the taxes, and everything's going to be fine because the Fed's going to protect your 401k, your IRA, and they're going to just inflate the market back up with more money printing. Problem is that the only reason they could pull this off for 40 years is because we started off at 20% federal funds rate, which was slowly pushed that high over the course of 15 years by Paul Volcker. So we had Alan Greenspan come in and realize, all right, it looks like Paul did a great job. We got rid of all the bad investments. I mean, who's going to borrow money at 20%? Nobody. In fact, that just drove massive amounts of capital to the US to take advantage of these high rates. But Paul Volcker did his job. Alan Greenspan came in. He did the exact opposite. He created the big bubble and he started lowering rates, which allowed money to flow into stocks. Okay. So what I want to do now is look at the past century, and we're going to look at just how easy has it been to be a buy and hold investor. And should we really count on the stock market going up forever? Or maybe should we count on the stock market delivering negative returns for the better part of a decade? And if that's the case, how do we deal with it? And if our stock and bond strategy is going to break down, what on earth are we going to do? Okay, so most important periods to look at here is after World War II. You had about, well, here, let's just zoom in. But yeah, I want you to focus on right here. We had high levels of inflation, 15 years of downward movement in the stock market. After World War I, we had the 1920s, great roaring 20s. What happened in that period? Both of these periods have some pretty interesting correlations to what's going on with China right now. So in World War I, the whole world was pissed off at Germany. They all wanted reparations. They lost millions of lives, all their money. All the European countries gave all their gold to America so that we would support them, send in troops. So America became super rich after World War I, and they wanted to get paid back. Belgium, France, everybody wanted all the money they could get out of the Germans. They're pissed. Problem was Germany had gone broke trying to fight the World War I as well. And so the whole story, it's fascinating. I totally recommend read as much as you can about World War I, World War II, especially from the central bank's point of view. But they ended up doing some crazy monetary policy because they couldn't pay the debt. So they started printing money to pay the debt. And sure enough, it created inflation. Well, once that first currency got out of control, they actually invented a whole new currency, which helped for a little bit. But the bottom line was the world punished Germany so much that it created a worldwide depression. And their economy was so important to everyone else's that it took a while, but it eventually created the greatest stock market crash of all time and the Great Depression. So you can see this is something like a 98% crash right here. Now in the 60s, this was after World War II. We had Roosevelt. We had so much social nets. We're giving out money like it's candy. We're going to get on the moon, just massive spending. And sure, we bankrupt Russia, success on that part, but at what cost? Well, we had a very nasty stock market from 1965 through 1980. And so you lost for 15 years well over 75% of your total net worth if you're buying and holding stocks. And there's plenty of times where it looked like it was coming back up. You thought the sell-off's done. This is great. Back to making money like we did from 1945 to 1965. But oh no, because the central bank had to keep raising rates because inflation could not be put under control. All right. What we're going to do now is I'm going to give you what I think is going to happen into the future, how we're going to deal with it with our portfolio, and then we'll go look at real history and see some examples of this playing out. Okay, so I think that a crisis will hit before 2021 that will force the Fed to drop rates to zero and do massive quantitative easing. Okay, so the crisis will immediately be negative for stocks and bullish for bonds and gold. And this is going to speed up our timeline of how long this business cycle can last, because the second we get to zero, and then we also get inflation, things are going to get hairy. So again, we'll be using our inverted option collar on the SPY and emerging markets, and we'll be using our loose option collar on the TLT and GDX. So what happens next? And this probably will be the trade war escalating, most likely. Okay, so we get to zero rates. We're doing massive quantitative easing. Eventually, what happens? You get rising inflation. So if there's rising inflation, which we're already seeing in China, 4.5%, Brazil just printed 2.5%, America just popped above 2 at 2.1 with some of our internal readings. So the Fed's already been, they already knew this was going to happen. That's why for the past year, they've been saying, you know what we want to do? We want to create asymmetrical inflation. We want to let inflation run hot to make up for the lack of inflation we've had over the last decade. Give me a break. Why do we want to make our money worth less at a greater rate? So from their perspective, the central bank wants to keep prices under control, but they want to incentivize investment. They want you to think that if I make an investment or purchase today, it'll be cheaper than tomorrow. Because if I believe my money will go up in value over time and that cost of goods will deflate, then what's going to happen? The economy will grind to a halt. So that's how they come up with this 2% inflation target. But the second inflation starts coming up, here's what I believe will happen. We're going to be in a period of 0% interest rate. That means money's free, massive fraud, massive scams, massive business models that don't make money. They just borrow for free and try to generate gross sales. That's going to be very bullish for stocks, but it's going to create a sell-off in the bond market and probably the last hurrah for gold. So that's where I think we'll see gold outperform stocks. Okay, well, what happens when the yield on the 20-year treasury gets above the inflation level? Well, we're going to have rising interest rates because inflation is picking up so fast that they're going to have to stop quantitative easing. They're going to start increasing the interest rates like we saw through 1965 through 1980. And this is what investors are not ready for. All four assets collapsing at the same time. So you have your stock selling off, you have your emerging markets selling off, and no one wants to buy a bond because they're fearful that the yield is less than the inflation rate and that yields are going to go even higher, which means you can't do what we're doing now. People are buying bonds right now because they think yields are going lower, which makes the value of a bond go up. But the second we have inflation, the mentality is going to flip. The fear won't be that rates are going lower so we can make a profit from bonds. The fear is going to be that inflation is growing, so yields are going to grow, which means I should wait to buy that bond. So this is where we're going to need that inverted option collar on all four assets. Now, this is not my pipe dream. This is Ray Dalio's entire theme summarized and put into a real trading plan that you can actually follow. This is exactly what he's predicting is coming in the next decade. It's not just him. It's all of the legendary hedge fund managers. Now, what happens after we get really high interest rates? That's what I call the reset. So potentially by 2030, we can have another era like we did with Alan Greenspan, where we can lower interest rates and have a long business cycle. And that might last another 50 years, but it's a ways off. And so we're going to be coming from high interest rates and be in a period where, okay, maybe it's time to lower interest rates and start up some QE again. And that's where we'd be back to long SPY, long bonds, and still short gold. Okay, any questions at this point, guys? Because the next part, we're going to look at real history.
I hate to show my ignorance, but what do you mean by quantitative easing?
Oh, sure. That just means the central bank is printing money.
Okay.
And they do that by purchasing bonds from the primary dealers, who are the ones who buy it from the government. So
Okay.
they'll do that as long as there's no inflation, because they know the more money we print, it makes each dollar worth less and it makes prices go up. And so we'll see that inflation is really the single most powerful driver of markets. And that's what actually makes the Fed decide to make changes. Okay, so here's your CPI index. The problem with this is inflation's already screaming hot, but they've been altering the formula to keep the business cycle going longer at the cost of some major distortions to the market. So we'll take a look at that. But here's your annual inflation rate. You can see it's been in a band that's traveling lower. And the simple explanation is, sure, we've created some great technology. You got your Amazon, you've got higher levels of productivity. We've got things like photos and text messages that we don't really know how to value. But the cost of goods has gone down. But a big pressure that's been pushing prices lower are these companies that can borrow money for free and then turn around and generate a business model that doesn't make a profit. So Uber and Netflix are two good examples. If they couldn't borrow money for free, they wouldn't be selling goods at a loss. It's just that simple. So we have this self-enforcing cycle right now that's rapidly growing the money supply, and all that money is flowing into the bond and stock and real estate market, and it's not coming down to your average Joe. So we've seen the cost of goods rocket higher while wages remain relatively flat. Okay, so it doesn't last forever. Eventually, money gets out of these different bubbles. People are cashing out. Just think of all the insiders. Like, for example, the Uber CEO has been selling every penny he has in that company as fast as he can. At the same time, they're doing corporate buybacks. So they're literally borrowing money from banks at nearly 0% rates. And then the insiders are selling their shares to the bond that they just borrowed so they can cash out. So money's cashing out. It slowly works its way. We're already seeing inflation hit China. We're seeing it hit Brazil. We're starting to see it in America. But the second out of control, the Fed has no option. So here's a look at inflation against the federal fund rate. That's the cost of money. Red line is your federal fund rate, the cost of money. Blue line is your CPI index. So here's what happens. They have a very simple strategy to get the cost or to get the control of prices within reason, to get inflation to come down. They make the cost of money go up and they stop doing quantitative easing. So lo and behold, every time the blue line goes up, what do they do with the cost of money? They just jack it up right above the inflation rate. So what happens every time we essentially cut off the government and corporations from creating new debt? You get your magical red line. That's negative GDP. So our entire economy revolves around growing debt to create this supposed growth. Now, every single time that the yellow line spikes, that means the cost of money is going up. What happens? You get negative GDP. That's very negative for stocks, and it's also negative for bonds. So they hate doing that because they know it means they're going to cause some serious sell-offs in the stock and bond market. Now, if we get the big picture and we can predict what the Fed's going to do with their federal funds rate, we can predict what the Treasury will do over the long time in terms of bond valuations. And so my prediction is that this puppy is going to slowly but gradually hit zero. It could take maybe, like Galaxy said, 18 months if everything's rosy. So if we get a phase one trade deal, we don't have inflation fears, everything's perfect. Yeah, maybe it takes them 18 months to hit zero. Slowly but surely, 25 basis point cuts every 3 months, maybe 18 months. You throw in some serious conflict with China and a escalating trade war, and you have China start hiking up their rates because of inflation, we're going to have problems much sooner. So the big picture is, because we understand that the Fed's not going to just let the markets collapse, they're going to do what they can to prevent that. We know their only ammunition is to do quantitative easing and push rates to zero. So that's how far the TLT can go up. At some point, the market's going to realize we're probably not going to negative rates, and we're going to have to call a top on the TLT around that period. And with my calculation, that's around 180 on the TLT. So let's look at inflation. Everything the government starts to subsidize, we get massive inflation. So as the Obama era came in and gave guarantees to banks to give out college loans. So now they're giving out loans to people who can't pay them. And the colleges are smart, and they jacked up prices real quick. So we have 170% inflation in college. Medical costs are up 100%. Housing costs are up 80%. But wage growth is flat. That's why we have this populist movement. The longer this goes on, you end up with revolutions. You get poor people stripping the money away from the rich. If you go back to 1980s, 1990s Japan, think of Elizabeth Warren and her wealth tax. You think that's not going to happen? The Japanese, in a sudden decision, pulled away 50 to 80% of all money for all the rich. 2% is nothing compared to what can happen when bad times come. So there is a very high degree risk of wealth distribution in the next decade. And that's why you got every billionaire under the sun coming out, doing all these interviews about how we need to create more social nets to help out all the poor people. And it's not because they're nice, it's because they don't want the poor people to realize they can take control of the government with their vote and strip that money right out of their banks. Okay, the inflation rate back in the 1990 metric, without, avoiding everything that's inflated, would be at 5% right now. So the federal funds rate should be above that, 6. It's at 1.75. If we go to 1980, the picture's even worse. The formula in 1980 shows an uptrend in inflation. If it's uptrending, we want to have that federal funds rate much higher, probably like 12 to 15%. Where's Paul Volcker when you need him? What happens when unemployment gets to record lows? Well, if you do listen to all the conferences with businesses, in particular, their hiring managers talking with Powell, all they do is bitch and moan that they can't find cheap labor. So labor costs are going up, profit margins are going down in stocks. Prices are going up, inflation, self-fulfilling cycle. All right, let's go look at some inflation rates and how that affected the stock market. Here's World War I, runaway inflation. We had the 20s, roaring 20s. Notice low inflation during the 20s. And then we got to 1930. We had deflation and we had the Great Depression. So what did stocks do during that period? Well, while we had inflation, stocks went down. While we had no inflation, stocks went up. When we had deflation, stocks crashed rapidly. Now remember, if you think your money is going to be worth more tomorrow than it is today, you're not going to buy anything. You're going to sit on that purchasing or investment decision. That's worse than inflation. That's why you had such a horrific crash in the 30s. Now, we got out of that with some massive quantitative easing, and that leads into this period. So 1945 to 1982. Notice from 1945 to 1965, inflation's under control. It's around 1%. You're incentivized to go make a purchase today, but you're not scared that it's going to inflate by 5, 10%. Massive, massive social programs. The whole world was doing this. We had a lot of pain from World War II. We wanted to help everybody out. All right. But eventually that money hurt us. We had runaway inflation from 1965 to 1982. And that's where you have those double-digit inflations. What happened from 1965 to 1982? Like magic, stocks went down. So low inflation, stocks go up. High inflation, stocks and bonds go down. Here's Paul Volcker, his actions. He tried his best to cut rates after hiking them. Every single time he hiked rates, we got a recession. You get your negative GDP print. It works like clockwork. He had to get the rates all the way to 20% before we could get all the malinvestment out of the economy. And that's what sets you up for the biggest stock run that most of you guys have been living through. So note from 1980 through 2000, inflation came down and it was relatively steady. What did we get? A massive bull market. Sure, we had a little recession in 1990, but nothing to worry about. Come the next few crises, well, they could fix the problem by just dropping rates 5 to 10%. And Alan Greenspan did that without blinking. The lower the rates go, the bigger the bond market becomes, and the more sensitive it becomes to inflation and changes of interest rates. Now in 2000 and 2008, we just barely needed a 3% inflation print to crash markets. Now you better believe these markets can predict the inflation before it hits. That's why we see the print in the year of the crash, not the year before. So what'd you get? Massive stock crashes. How did they recover? Cutting interest rates, doing quantitative easing. Janet brought us to zero. Obama bailed out the banks at the worst speed in history. We should have let them go bankrupt for loaning out money to people who can't afford to pay for their house. Instead, we actually paid them a huge profit for wasting all of our tax dollars. So we've deflated the money, or rather the value of our money, the longer we sit at this 0% rate. That's the worst thing we could have possibly done for America. We did it for 5 years straight. All right, Trump gets elected, tax cuts, stock market's on fire. Fed's like, this is our chance. Let's get those rates right up to 5%. Then we can save the day next time. But it's too late. There's been too much money floated into corporate bonds and sovereign bonds. And now just a 2.5% interest rate hike crashed all markets in 2018. So what did good old pal do? He cut the rates and started up QE. And here we are. So if you think that's going to keep going up, good luck. Because we're almost at 0% on the federal funds rate. And that's when the game's up. Now, some things that could expedite it, probably trade war, most likely item. And so we'll see when the trade war escalates. But I think that's going to speed up the timeline and make trading much more difficult for everyone. All right, guys, so that's a wrap for the current presentation. I'll go for about 2 hours a day. Tomorrow I might do a little bit different presentation. So if you want to learn about China and why they're probably going to have to go into a recession and cause everyone else to follow it, I might be able to jump into some of that content tomorrow. So if I do see some familiar faces, we might try module 2 of our boot camp, a little bit of that content. If you did enjoy your program today and you'd like to upgrade your free trial, call Dean at 505-322-7515. We'd love to chat with you, see how your portfolio is positioned, see if we can't help protect that nest egg coming into the 2020 election. There's almost surely some volatility ahead. Any questions out there?
Hey, Jason, I want to say thank you and want to also relay. So, folks, my name's Dean Gallagher. I'm a partner and investment coach with the firm, and definitely love, chatting with our potential clients, looking over their portfolio. I've just with so many people I've chatted with, I've found things that were just way too risky for the customers. Just for the individuals, basically time in life. And just have found a lot of people too that were just an insane amount of cash that wasn't invested, and we're definitely in a high inflation period. I don't care what the government tells you. You're looking at probably 5 to 8.5% across the United States. So it's just love to learn more about what you're doing. Share some of my success with you. I'd love to, learn what's been successful for you, and also learn where you've struggled. So that way, Jason and I can identify, how we can help you the most. And definitely look forward to that opportunity. And like I said, call me. My number's up on the screen there. Just save it in your cell phone, and call me when you have a moment. And it's 505-322-7515, just in case you're not on the webinar. I know a couple of people are calling in today. So yeah, just feel free to reach out anytime, guys. And please, any additional questions, please feel free to reach out. I'd be more than happy to address them with you. Okay. Thank you, folks. Appreciate your time. And please, if you have any additional questions, ask away.
Oh, look who joined in. Hey, Brent. The replay will go out a little later. Actually, if you just go to your Trade Alert email and click the link in about 15 minutes, you can rewatch today's presentation in case you missed it. So yeah, the link you guys clicked in the Trade Alert will actually replay this webinar in about an hour. So if you do want to rewatch this, just go click that and you can rewatch the whole presentation. Thank you very much.
I have a question.
Oh, sure.
What are you using to trade? Are you using TD or do you have another broker? Because TD has something wrong with their system right now, and they cannot, every trade I make on the SPY has to be called in.
What in the
They don't-
heck?
They don't know when it'll be fixed.
That is bizarre. Well, I think Ameritrade's by far the best option. I would switch over to their mobile app and be a little patient with them. The screenshots you see are a special software I have. They're just really easy to kind of illustrate what we're doing. But that's not what I really trade with. So I
Okay.
would stick to Ameritrade. I think they'll figure it out. If they don't, maybe consider Schwab, who just bought out TD Ameritrade. And so I definitely stick to those. I think they'll figure out what's going on how long has this been going on for you?
Just since I started with your system, I haven't bought covered calls before. And so just since Monday, and I finally talked to somebody today during your program, and I said, what's the deal? And he said, even on the mobile system, they have something in their system right now that thinks that it can't put together that you own 100 shares when you're selling a naked call.
Interesting. So yeah, it's not recognizing that you have 100 shares for the covered call.
Right. It's not putting them together. And then when I did it last Friday, when I first started with you, I did a covered call. I bought the shares and sold the call at the same time. So it was fine. But then Monday, when I got out of the Friday trade and put in the Monday trade, it said, no, you can't do that because it doesn't know I have 100 shares.
Very interesting. Well, let's give them another week to fix the problems. Keep calling in and complaining. And if they haven't fixed it, we could talk about some other brokers. But I love Ameritrade. I love the customer service. I love the cost. Interactive Brokers is a little more ugly in terms of the platform, but still very cheap rates and a safe broker. Schwab, we have a lot of clients who use Schwab with 7 figures following the program.
Do you ever do Tasty Work?
But yeah, those are the only 3 I really trust, to be honest. Schwab, TD Ameritrade, and Interactive Brokers.
Okay. All right.
And, William, did you recently get approved for covered calls?
You might need level 2 option trading.
I talked to the guy on Monday and he supposedly fixed it, but then the fellow I talked to today said, no, it's a system problem and not my account problem. And no, I just switched over from Tastyworks to Thinkorswim, and so
How strange.
yeah.
Okay.
I bet they fix it within a week. There's such a huge company. I bet they have so many people calling in complaining about that if it's really a global problem,
Yeah. Okay.
universal problem.
Client-wide problem, right?
It might be, do you have any other trades on besides what we're doing, or is it?
Well, before I found you, I was working with Option Alpha, and so I have a lot of iron condors. And
I bet you it's something to do with all the other positions.
I have a SPY iron condor that expires the 20th of December. And that's part of the reason because I've got all these positions on. I think I have 9 positions on, and they're all losing money.
Yeah, maybe. I bet you it has to do with all those other positions you have on.
Well, they're going to expire here pretty soon, so I'm not renewing them.
Okay, good. Well, let's see if that fixes the problem. I guarantee you that's what it is.
All righty.
I see a guest rose their hand. Please go ahead and ask. We'd love to hear from you.
Yeah, Jason, it's me, Gary. Back when I first joined you guys and I was complaining about, I had E-Trade, I was using E-Trade. And I was complaining then, well, not complaining, I was questioning whether or not your service would be any good for me because of the transaction costs. And either you or,
Dean?
Who?
Dean?
Yeah, either you or Dean one said use Robinhood. So I switched to Robinhood. Now I don't hear you saying anything now about using Robinhood. I'm
You know,
happy.
we have people who like Robinhood. I had one client who put $500,000 in Robinhood.
Wow.
And then and he's crazy. This guy's doing Tesla. You know, he wasn't
Yeah.
really following the program, but he lives right next to their building, and you know, he's putting money in, money out. Just kind of a crazy guy in general. But he got so impatient with their customer support desk that he drove to their office and tried to march in there, raising hell. And I guess the security dragged him out and threw him on the street. So after I heard that, I stopped recommending.
Yeah, I'll agree. Customer service sucks. You know, it's almost impossible to get a hold of them by phone. You have to do everything by email.
Yeah, and now Ameritrade has almost free everything, not completely. So I like that Ameritrade. You know, you go back to the old selling products at a loss. Well, you know, Ameritrade's certainly selling their service at a loss. When you get phone support and free equity trades and almost free option trades, well, that's a heck of a deal. Now the program's so easy. You know, once you get it going, we do have a lot of people on Robinhood, for sure.
Well,
And
I
they
like
have a
that.
nice phone app.
I like that part of them. Yeah, I'm not really. I'm sort of technically challenged, so I use what they call the web, and you know, and because this is such a simple system, Robinhood's fine for me. It's a little awkward. You have to do things systematically, and
Yeah, you might consider going over to Ameritrade. Their phone app is so clean, so easy. I can put the trade on in like 3 clicks.
well, I don't know. I sure like this idea. No, everything's free with them.
Yeah, but you know, if it's not broke, then why fix it?
Yeah, that's where I think I'm going to stay like that. You know, they even they have a Robinhood Gold where they charge you $5 a month, but they give you the first $1,000 of margin at no interest or interest free. So
Yeah, they have cheap margin, a lot
Yeah,
cheaper than Ameritrade.
5%, and I was paying sometimes 11 to 14% with E-Trade.
Ooh,
Yeah,
and the federal fund rate's at 2. What a ripoff.
Yep. At any rate, okay, thanks. I just wanted to make sure that you hadn't heard something new about Robinhood and how to get out.
No, well, yeah, once Ameritrade came out with once Schwab came out with the free trades, and then Ameritrade followed suit, and I heard about the poor fellow getting thrown on the street after I think put 300 grand in there, something crazy. I was like, all right, we need to.
No, they're actually pretty good. You know, on email, they get right back to you.
Yeah, I've had good experiences with Robinhood, and quite a few of our members have used it. So,
Okay, thanks. Oh, I got one more question.
Is out there?
Jason, I got one more quick question.
Sure.
I checked in to this webinar a little bit late. I got right in at the point where you were talking about a free trade, something to do with a $35 call, I think it was, call option on VIX that expires in April.
Right. I would wait till Friday. Let's revisit that on Friday.
Okay. All right.
Okay. Because we got the Fed announcement coming out right now. You know, if we do hit my target on the SPY trade today, VIX will be cheaper on Friday.
Okay. All right. Thanks a lot.
And then the big catalyst is Sunday. If the tariffs really go up, the VIX will spike for sure.
Okay. All right.
All right, guys. Thank you so much. We'll have a slightly different presentation tomorrow. So come back. We'd love to hear from you and teach you some more big macro picture of how the program works. We'll maybe look a little more at China and Hong Kong and some big opportunities there. And thank you all for joining.
Thank you, Jason.
Thanks.
Thanks,
Thanks,
Ray.
guys. Have a great day.